Hey, it's Jeremy with Strength in Numbers again. Long-term disability is one of the two insurances people don't talk about because they're uncomfortable topics, but they're very important. I'm going to explain it to you step by step today about what it is and why you should have it. Long-term disability insurance can often be difficult to understand, and most people are more familiar with short-term disability simply because they are more likely to use it and often do. But short-term disability is often provided through your employer, and even if it isn't, that's why I recommend a 3 to 6 month emergency fund that will help you self-insure for short-term disability costs and time periods. But when it comes to long-term disability, it's here for 3 very important possible reasons. Number 1, you have a long-term disability that's simply longer than short-term disability covers for until you can get back on your feet and to work. 2, you have a disability that is not for the rest of your life, but it is for a long period of time because it has removed the ability to do what you used to do. So if you're on the radio and you lose your voice, you can't do radio shows anymore, and different things like that. So it's that kind of coverage. And then thirdly, it's for the catastrophic. So if, God forbid, you were injured in such a manner that you could not work for the rest of your life, whether that is a physical injury or that's depression, I've seen people in that situation as well, and you're not able to work, it's going to replace your income for the rest of your life, sometimes up to retirement age and sometimes up to the rest of your life as well. So those are the 3 kinds of situations in which you would need long-term disability coverage, and I strongly encourage you to get that in place as soon as possible so you're not without that coverage. But on the board here, I want to walk you through a fictitious example here of how the timeline would work out if you had long-term disability coverage and how it would pay out and when it would start paying out. So let's pretend, for example, that you get injured on the 1st of the month. Now, you're not going to see the doctor that day. Let's say it takes you another week to get into the doctor, and so you get into the doctor on the 8th, and that day he declares you disabled. So that's the day in which you're going to be declared disabled, and that's when the elimination period clock starts ticking. So if you've got a 30-day elimination period based on this policy example, it's going to take you all the way until the 7th of the next month to get a paycheck. So that means you've got to cover your own butt from the 1st to the 7th of the following month. That's why it's so important to have an emergency fund in place. Now, when you do receive that check on the 7th, it's going to be whatever percentage of pay your policy is for. So you have 50% of your pay, then if your gross income was $4,000 a pay period, whether that's a month or every 2 weeks, you're going to get a check for $2,000 every month, therefore, based on your monthly pay and the percentage based on that. So it's very key to have that in place. Now, in just a second, I'm going to go through the specifics of what each of these things mean, but I want you to understand a quick timeline there first, because it's very important that you understand where you've got to cover your own butt until you get a check. So what should you look for in a long-term disability policy? Well, first, we should look at percentage of pay. You should be looking for a percentage of pay that's as close to 70% as possible. And here's why. If you're paying the premiums in your long-term disability policy, which is often why you'll see it on your pay stub as an after-tax deduction, then the benefit of the long-term disability policy is non-taxable. Okay, so if we're getting paid 100% of our pay right now, after taxes, we're coming home with about 70%. And so if we're getting a disability check that's non-taxable at 70%, it's pretty close to or equal what we used to be making when we could still work. So that's the first thing. It's hard to find 70%, but don't let that stop you from trying, because we want to get as close to replacing our income as possible. The second thing is the elimination period. If you've only got a $1,000 emergency fund right now, then you're probably going to have to take a 30-day elimination period because you can't afford to stretch that much longer. But if you've got a 3 to 6 month emergency fund, you can take that 90 or 180-day elimination period. And of course, the longer elimination period you take, the lower your premium is going to be on this policy. And so those are 2 key factors. The third factor is own OC. Own occupation coverage is something you can add onto your long-term disability policy, and it's something that's going to cover you in the event that you lose the ability to do what you used to do, like my radio example earlier, and it covers you until you can learn a new career and get back into the workplace. That's a great feature to have. So first, a percentage of pay that's close to 70% as possible. Second, an elimination period that's in conjunction with your emergency fund. And thirdly, an own occupation feature. I hope this has been helpful for you. I strongly encourage you to get connected to a good quality independent insurance broker to get quoted for these long-term disability policies, and that you don't delay. Put it in place. It's something that people tend to put off for years, and it's dangerous. Don't do that. So get that long-term disability policy in place. If you want to talk about the specifics of that, get more educated on this stuff so that you can walk into the broker as an educated consumer, then just reach out to me. I'll be happy to help you. This has been Jeremy with Strength in Numbers, helping you keep your wallet heavy and your heart light.